All right, everybody, let's get into support and resistance here. Now, this is about location, right? And of course, these locations can look different, and reactions to these locations can form different patterns. And we talked a bit about that in the candlestick section. We're going to talk more about that, of course. Let's look at some of these concepts. All right, so the theory of self-fulfillment. This industry focuses a lot on different analysis tools to determine turning points, trend changes, and they use some of these tools to determine when this happens rather than using the price itself, which I can't say that I sidestepped doing some of that type of analysis in the past because I was exposed to the same things you are. But after a period of time of seeing how inconsistent it was, and just a common sense thought process eventually to say, how is it possible that if I connect a line from here to here, that somehow magically, based on some golden ratio, that it was going to place lines on my chart that would somehow mystically uncover support and resistance areas. And while I immediately did not dispense that thought, I went with it and researched it further and further, tried to make sense out of it to the point where it's like, this just doesn't work. But even to this day, you can turn on CNBC and you have, the lineup of so-called technicians getting in front of the screen, putting their finger on it to draw lines and connect the dots, and saying this is the long-term trend in support, and if it violates this line, something bad's going to happen, or something good's going to happen if it goes above the channel. It's ridiculous. And I can tell you one of the turning points was when I was reading Barron's magazine on the weekend, which I did every weekend. I would go out on Saturday and buy that magazine and read all the technicals in there. And there was an article in there, I believe it was possibly on, I don't know if it was on the S&P 500 or whether it was on possibly Coca-Cola, I can't remember. Anyway, at the time, Barron's magazine is about half the size that it used to be, meaning the size of the paper, the height and width and all that. It was a giant paper back then. And on that big paper, it was probably a 5 to 7 page article with channels and lines and commentary explaining as to why what was happening and this long-term trend that was changing and was going to start going down and so on and so forth. And as I read that and I was like, wow, this guy is good. This is so convincing. And it didn't even come close to being true. And that was one of the turning points. It was like, if something could be written like this that was so convincing, I mean, it seemed like was logical, and of course you're looking at something that you already agree with. So what's being shown to you is, in a sense, already what you want to be told. So you're already brainwashed, and then as time goes on, for me, this stuff doesn't work. It seems ridiculous to be connecting dots and those lines projected into the future are going to be support and resistance. It seemed even more ridiculous to connect highs and lows and ratios of lines coming on the chart would be support and resistance. And if you had various lines drawn from different swing highs and lows, as those retracement levels would overlap each other, and that would be even stronger. And you see that still today. To this day, you see people doing that type of analysis on the internet or even possibly on TV and showing that. And everybody looks at it and like, wow. And nobody says, how could this possibly be? What type of magical tool is this that uncovers these hidden support and resistance areas? It's like a magic show. And everybody goes to the magic show thinking, well, we know that it's magic and it's really not true, but it's convincing. That is part of what support and resistance is through the tools that are used today to try and convince us that this is what is needed. So, trend lines, moving averages, the crossovers, channels, fib lines, and such. Locate support and resistance. And of course you ask, I did, why do prices reverse there at time? Well, because so many believe they are. They're looking there. They act at those locations with these tools. So one of these types of tools that I used years ago when I used to trade equity E-minis exclusively was called trader pivot lines. And they would be lines placed on a chart based on a calculation of the prior day's high, low, and close. And it would project lines on the chart. So why did I use it knowing that it was a subjective tool? Well, one of the reasons was that virtually every other trader that was trading those things, not every, but the vast majority, because they were trained to use them, they were called floor trader pivot lines. This is the way the floor traders years ago used to find support and resistance on the floor. They would calculate these numbers, and that's where they would place their trades. So they're still used today. But one of the advantages of that type of a tool versus, say, a Fibonacci retracement or a trend line is that because it's based on the same numbers that everyone is looking at, the lines are all in the same place. And they become what we call a self-fulfilling prophecy, meaning that daily pivot line or that R1 or S1 becomes a focal point where traders are going to act. And that's, it's a self-fulfilling prophecy. So many believe it, so they act there. So it made sense to know the location of that subjective tool. We'll talk about moving averages pretty soon. Something like a 200-period moving average is a line on a chart calculated based on prices. It's so widely followed, it can become a self-fulfilling prophecy. And the moving averages that I'll talk about that we'll use, we use them because they become self-fulfilling prophecies where institutions will act on the daily time frame. So these things are subjective, and it can lead to uncertainty if you don't know how to use them or the subjectivity of them. Now, supply and demand is what's going to move the market, buyers and sellers. So at these support and resistance points, that's representing commitment with real money. If there's a swing low or a swing high or a base, some area of congestion up above, you know that people have money tied up there. So when it gets that area up above, those people want their money back. So you can rely on that area to have some type of an effect on current prices. Now, it's not just totally black and white. If there's an area of resistance, that prices can't go through it. It should stall it. If it does go through it, that's great information in of itself. There'll be times when it moves sideways at that area, and that's great information in of itself. In any event, we say price is the only truth in technical analysis. It's not subjective. It comes from the data stream. It's put on your chart for you to see. The only way you can manipulate it is to change the time frame. And that will make it look like something else. But I've already started to show you how changing time frames makes those candlesticks look like something else. But you understand that it means the same thing. So, by changing time frames, it doesn't become a mystery to you in the way that someone who uses a moving average in a way that doesn't really understand it, and all of a sudden a 50-period moving average is in a completely different place than where it was on the time frame they were looking at, or their trend lines no longer match up in any way from the way it was before, or their Fibonacci lines, the pivots, the lines that they drew from, the highs and lows, they're not there anymore as they condense the data. And they're like, where do I draw from now? And it becomes a vicious cycle of going around and around, being confused. And this is why so many that come to the markets and want to learn technical analysis cannot do it. And in a large part, it's because of an industry that continues to this day and has done for decades to use subjective analysis tools that are not based on reality. They're based on golden ratios and projecting lines into the future for some reason that are supposed to create some support or resistance. And when you start to think about it like that, it really is something that you think, this is ridiculous. Anyway, let's move on. All right, so here is what I call a maze of confusion, the Fibonacci lines. And I've really made it relatively simple here, just drawing from this low to this high, and here's the retracements. And when they line up like this, somebody that shows it to you, I'm telling you 99.5% of the time, that line is going to line up with some price area. So all you need to do is look to the left and see what's there. And that's what your focus is. Is it in an uptrend and it's pulling back? Look to the left. Now, if you're a Forex trader, right, you trade currencies, that just happens to be the one of the indicators of choice for Forex traders. The more leveraged instrument you get into trading, the greater the tendency for the esoteric types of analyses tools. Even to the point where if you started trading corn or maybe oil or what have you, you could probably run into somebody that, has a square of 9 figured out as to what time of day and whatever it is that the market's going to turn, or Gann lines, and it goes on to the point of, it's kind of like a circus, honestly, and all of these different tools. So anyway, they draw from multiple points for stronger reference points. And then what does that mean? They draw from here to here, they draw from here to here, they draw from here to here. And then the lines that are in the middle of nowhere, well, they just click those off, and they say, well, see where there's a cluster of lines here? That's going to be the hidden point. Okay. And for X amount of dollars, I can show you how to use this software effectively to find those hidden proprietary points. That's the kind of stuff that is being promoted out there. And then eventually you move on to something else. Right? Just look to the left. So here's the Master Trader Strategy, 7 points for mastering support and resistance. What are they? Reference points. Price area, a base, a pivot, swing high and low. We see them on our chart. They're right there for us to see. No tools needed. Prices are going to move between those reference points of support and resistance. That's part of our thought process. If there's an area of resistance up here, there's a support down here, and prices turn up from there, the assumption is it's going to go up there, and then we'll see what the reaction is to it. And we're going to have other rules. So when I say it's going to go from here to here, well, what if it goes from here to here, and then it stops and starts to do something? We'll talk about it. So buyers will bid at support. Right? So as prices come down to support, there are going to be traders that are going to be bidding. So if you look at your level 2 and you look at the bid side, those are the traders that are bidding. And as prices come down to an area of support, you'll see more bids there. And as it comes up to resistance, there'll be more sellers on the offer. And that's where reversals will typically occur. Now, when there are areas of congestion above and below current prices, one of the questions you should be thinking, well, how far above and below? Because if they're very far above and very far below, well, that leaves a lot of room. But let's say, for example, this was our area of current prices, and this was what was above, and this is what was below, the odds of being chopped around are extremely high. So when we see that, we stand aside till we wait for somebody to take control. Buyers to push above that resistance or sellers to push below that support. Now, when prices come up to an area of resistance and they move sideways, that's bullish. Think about it. As prices move up, let's say that this is our resistance area. Prices move up to that resistance area, and rather than backing off, they go sideways. That would be going sideways right there at the resistance. And it's doing that because that resistance, we associate it with being supply. The traders that want to get their money back, they have losses. They want their money back. But buyers are saying, well, I'll take your shares. I'm okay with it. I think it's going higher. And sideways price action at resistance is bullish. The other side of that is sideways price action at support is bearish, meaning when prices come down, let's say prices had come down quite a long ways. Let's draw that out a little bit here. Let's say prices, they came down and then they accelerated down here, and this was your support. And at that point we say, you know what, it'll probably bounce from there. And rather than bounce, it does this. Well, that's more likely to result in a continuation because the demand that stalled it there wasn't able to push it higher, so it drops. And then, what if there's a void? Void meaning there is no support or resistance, and we're going to look at that. So these master trader concepts, they're going to remove the mystery from the price action. That's the goal. That's my goal here in this seminar, is to remove the mystery from price action by removing indicators and showing you how to understand that price action without them, and then putting it all together, okay, as we get there. All right, let's go on to part 2 of support and resistance. Support and resistance, part 2. Possibly you've already gone through the free foundational course on the site, so this will be a little bit of a review. But it'd be great, since we're going to be looking at this in more detail now. So covering minor and major support, prices are moving up, making higher highs and higher lows. It says minor support is defined as the prior high in an uptrend. Meaning as prices were going up and then pulled back, there was some resistance there. It's in an uptrend. Say, how significant is it? Well, was it significant enough to cause a pullback? But once through it, that becomes our reference point of minor support. Now, after the trend is moving, this continues. So once the high is taken out, this becomes minor support, and then the low prior to the higher high, that becomes major support. So there's the definition. So as long as that continues in that way, our reference points continue to be adjusted. Right? So as we would, minor support, major support, and if it was to pull back there and then turn, once it took out the high, we would just continue the process. Minor support, major support. That's simple. So in a sideways trend, we need a few retests to happen. So after it retests on the third retest there, we then consider that to be major support, and on the third retest, that to be considered major resistance. However, if we are to get a retest after a climactic move, and we'll take a look at that on a chart, but after we get a climactic move and then prices retrace from there and come back down to it again, we just consider that as a significant reference point of support where buyers stepped up. And with any support point, the use of it is to anticipate the potential for another turn. And then, of course, we wait to see what candle pattern formation forms there to confirm it. It's the opposite in a downtrend, lower highs and lower lows. Right? This low right here becomes our minor resistance reference point, and the high prior to the lower low becomes our major resistance point. And you can see how this comes into play when we get into the trend section, and how this becomes an integral component of that, and how all of this comes together. So you've heard this term, I'm sure, before. Resistance, once broken, becomes support. We say supply becomes demand. And support, once broken, becomes resistance, or that demand point becomes supply. So the terms supply and demand, we use them with support and resistance just to reinforce those reference points as being that resistance point, is being where there are sellers, or supply, and support is where there are buyers and demand. So we have a downtrend, and as we are seeing prices trending in this case to the downside, we just continue to update the information as it forms. So as prices move down past the prior low, right, we then have this minor resistance area, and as it goes down further, we then mark off a major resistance area, and minor resistance, major, and we just continue on and on and on through the process. And as we continue to mark off those resistance areas as they form. Now, creating new support, new minor and major reference points as the trend progresses, and we've already touched on this. So as prices had come down here and they couldn't get through, and there was this resistance area as prices were backing off from, I want to say once they exceeded that, we then call that minor support. And so I've got the green line here now. So as prices pull back into that area, we then look for buyers to step up in that area, stronger demand. And here you've got bottoming tail candles. So you'd have confirmation of that. Now as prices move up toward this resistance area, we really are anticipating that prices would be able to push up above that. And you see that didn't happen here. Why? Could be the market at the time was pulling back. It could be that whatever stock this is within a sector, it may have been affected by something that was happening in the sector. We just go by the patterns, and I'm pointing this one out to you because it really looked like it could go higher based on higher high, pullback, bottoming tail, nice consolidation prior to the move, wide range bar up, inside bars, but it didn't take out the high of those inside bars. So we didn't have the confirmation there. However, prices pulled back in, and when they do that, we really don't know that it'll hold this support, but the fact that it was nearby tells us that the next reference point is right there, and buyers should step up. A lot of what we do as technical traders is observe the reaction to reference points. For example, here you got a bottoming tail bar at the reference point. So buyers did step up and defend that area as they did here. And I say buyers were lurking down here. Buyers continued to come, and then prices pushed back up again. Versus the possibility, which could have happened, was that prices would have just dropped down here, or they could have held here for a little while and then continued lower. And I tell you that because at different times in the market, whether it's the market environment or, as I said, the stock being in a certain sector, we have our foundational concepts that we use for guiding our thoughts and expectations. However, we have to always have two scenarios. We'll talk about that in the psychology section. But anything can happen. But we use these foundational reference points as such, and then to see what happens. And as long as the price action is happening in alignment with what should, well, things can be, in this situation, not ideal, because the ideal would have been for it to continue to move up, of course. However, the less than ideal was still holding this area of support, and then prices moved up. So then once they exceeded it, this resistance becomes minor support, and you say it didn't even touch it. And here's the concept of new support being created. And what that is buyers are stepping up here above this minor support level. And this move up has created, we'll get to, a price void. It was a sharp move to the upside here, and now there's nothing underneath. But that strength of that move is supposed to bring in new buyers that recognize that. And it can happen in different ways. It could have pulled back and turned higher. And in this case, it went sideways, which is more bullish. And every time it dipped down, little tails formed, and then a bigger tail and such. And it then continued to move up. And as it made new highs, it created new minor support, new major support, and the process goes on and on and on. So here's an example of a climactic type of a move. Look at how prices are accelerating to the downside. And what is this here? What do we call that? Bottoming tail, but also a range expansion bottoming tail. And it was also a extremely large bearish wide range bar. It was actually longer than this one. So as prices were moving down further and further, and this was becoming climactic, at some point buyers began to step up while this was a long red bar, and that demand pushed it back up, a strong signal that buyers have taken control. Now, can you buy it above that bar's high? Yes, you can. You can, with a stop below the low. I'm not, this isn't one of my favorites. It does work. But when I see this type of price action, that gets me excited. Because now as it's moved up, some of the fear, the bearishness from this extreme move to the downside, it begins to dissipate a little bit more. Because you've got 3 bars here, and reading bar by bar, every time it dips down, buyers step back up again and pushes it back up. And you've got a couple of more bottoming tail bars. So this is a great buy right above here. And I might get a little more aggressive in my share size based on that. We'll talk about that in money management. And then as it pushed up, it stops right at the resistance area. Right? There was no resistance here because of the way it moved down. And it stops right here. And the size of this candle, which we call being very potent, suggests it's going to go lower. And then the way we read these candles is that once we get a big wide range bar like that, we want to see the candle bodies. Right? Here are the bodies. We want to see the candle bodies stay in the lower half and ideally in the lower third. At times the tails will get a bit deeper, but we want to see the bodies staying here. You remember when I talked about what was potent and we looked at an example of what had gapped up. And I drew for you, and it was actually a green bar, and there was a big red bar here. And I said it wasn't potent because if you looked at it as a line chart, it just looked like that, and it just went sideways. And this is the same thing. Get rid of those lines there. It's the same thing. It came down, and as it attempted to retrace, it couldn't. It stayed down here, and that tells you it should go back down. Do you want to short this to the downside? I wouldn't suggest you do it just based on this chart that I'm showing you and assume that they all work out that way. But if this was a daily chart, for example, and this started to move down and you're an intraday trader, this is certainly an example of what you could start your day with the next day as an intraday trader and be looking for short opportunities in downtrends on 5-minute time frames as this moved down here. However, once it came down to what we now will call major support, we look for evidence, price action, that buyers are actually taking control. down in that area. And we see that actually did happen, wide range bar igniting. And when we get into volume, right now, as I said, volume is secondary. The ideal scenario would be to have big volume on this chart. And I will tell you from my many years of experience, this can happen without the big volume. Sometimes the turn happens on relatively lower volume or average volume, and then the volume really picks up over here, because that's where it becomes very clear and obvious to many that this is really starting to go up. And then you see the volume pick up. And if you to see the volume pick up over here, then you know it's probably getting close to the end of the move. And what do we have here? We have some contraction and then a wide range bar. And if we saw a huge volume there and then the momentum slows down, you're definitely going to start trail stopping or taking some money off the table in that type of scenario. Also notice here the topping tail, there was no follow through to it. So imagine you bought down here and you see this topping tail. Some of you are going to hit the sell button as fast as you can get your hand on the mouse. But what I'm telling you is when using proper money management, maybe you won't, and you'll give it a little extra room, maybe down to here, to let it wiggle. Now, as it came up here, I'm getting a little ahead of our lessons here, but I like to do that to reinforce concepts, repetition. Right? That's how we learn. So let's assume that you did get in here and you had a position where you could sell some shares. And right up here, you offered out. You put some money in your pocket. And then you held on with your stop down here, letting it do whatever it might do. And then once prices came back up here, right, remember, you're going to be affected by this type of price action because we're pattern traders. It's going to have an effect on your thinking. And a bearish candle, or like a topping tail, is going to produce thoughts that it's going to go down. And it's normal. However, I've said that, in an upward trend, and this isn't quite up yet, but as things are moving bullishly, bearish candles get less respect. So if you sold some up here, by this point in the move, that thought of, hey, this is going to pull a bin a little bit, it's gone. So bar by bar analysis allows you to update that information and not get caught up in the past. Now, as prices moved up, the year you had a wide range bar, but it happened after a little rest. And now we've got a little building up of support, these several days of going sideways here. And that allows it to continue to move higher. And we just continue to repeat this process as it happens. And here's another example of a climactic move in creating support. So we had a move to the downside. When I say longs are in hope mode over here. So as prices are trending lower, and they're stalled here, and they're, if you are long in a situation that isn't working out, right, try to put yourself in that situation, and you see this green candle, you're in hope mode. This is coming back. It's going to be okay. I'm going to get my money back. And it dips back down, and you feel the pit of your stomach getting tied up again, and it comes back up, it's okay, and then right back down again. And at this point, you should be seriously reconsidering the possibility of it coming back. And then, as it begins to fall, those longs that were in hope mode here, they're just saying, I want out of this thing at any price I can get out. And they're just selling. They're bailing at this point. And this is what makes a climactic type of pattern. And then the wide range bar at the end, right? At some point in your history, this is you unloading your shares. Right? That's what happens to all of us at some point. That was me at some point. And you need to remember those feelings of when you sold the bottom tick. Because when you relate that to patterns, you really understand the pattern from the point of view of what others are experiencing and feeling. And then you see price is beginning, in this case, to stabilize. Most times these climactic patterns, they bounce up a little bit and they come back down again, because they are still bearish. And there are people that were buying on the way down, because if they weren't, this would be just one giant bar, right? But here on the retest, this is beginning to create some support here, and then the process starts again. Now notice the ranges here of these candles as prices come up into this area. Momentum slows down. So here, momentum sped up, and then as it comes up toward the resistance, it slows down. But it's continuing to move. Now we get a red candle. Notice this little breakout here. Not the kind of breakout we'd ever buy, because it's right in the face of this resistance right here. But notice what happens. It comes right back in. It hits that bottoming tail, that little shelf of support, and comes right back up. What does this look like if we condense the data? I'm drawing it. All right. It's a bottoming tail bar. So here we have a multiple bar reversal that would look like a bottoming tail bar if we compress the data. And as it continues, and it grinds its way up through here, and you could look bar by bar as it moves up, bottoming tail bar right back up again. It's kind of a grinding type of a move. Right? Sometimes you see those, especially with a pattern like this. Okay, that's the end of this section. Let's go on to support and resistance, part 3. Support and resistance, part 3. The void of support increases the odds of trending lower and vice versa. What is this void? Well, it's just that, a void. There is no support or resistance above or below current prices, and ideally in the direction of the trend that you're trading. So in other words, if you are trending an uptrend or a climactic buy pattern or some type of a bottoming pattern, there's a void of reference points of overhead resistance and vice versa. So if prices are moving sideways within a void, it could also create new support or resistance. Part of what we are doing is not only to simplify different parts of technical analysis, but to also understand why prices move as they do, and to have a systematic way of updating information as it occurs. For example, we see a bottoming pattern, stage 1, that's turning up into an uptrend of stage 2. And if you don't know what I'm talking, stage 1, 2, 3, and so on, just go back and look at the free foundational course toward the end there, where we cover the foundational technicals. So as they're moving up and we see this large void of overhead resistance, the assumption is that it can get up to some resistance area. However, we have to have an objective method to update information, in that what if prices start going sideways and then move lower? Well, then it's created a new resistance area that has to be dealt with if prices do turn back up again. So as we look at various concepts, we also have the other side of having another scenario. Well, what if it doesn't do as I think it will or might? Well, I have to have, as part of my method, ways of interpreting that and then what to do with it. That's what we're going to be moving into next. So, understanding this, the movement of prices. Prices move, I've already said in the past, between areas of support and resistance, and that affects price movement. So, we assess these areas and update new information as it forms. When there are these voids, prices are going to have better odds of moving rapidly or trending. So as you see various setups, candle pattern setups, that suggest prices are going to move in one direction, if there is little to no resistance to the left for a long setup, odds are it's going to be able to move more rapidly. And as you study this over time, you will see how this works. And in that, when there is some congestion to the left, prices will stall there, they'll be choppy. It doesn't necessarily mean that prices are going to turn down from there if you've got a strong signal of prices that are going to move higher. However, you'll often see the prices stall there, and once they get beyond it, the momentum picks up into the void as it moves up to the next area. In addition, there'll be times where you look at a setup, a price setup, a candle pattern that suggests prices are going to move in a particular direction. And while it begins to do that, the price action may be erratic, or maybe the pattern even fails. And that most of the time it's going to be because there's a lot of resistance overhead. There isn't that void. So when we look for high probability patterns, one of the concepts that we're going to put together is, does it or doesn't it have a void? So as I said, this means that there are no areas of congestion swing highs and lows to the left of current prices. So voids are created by rapid price movement. This is rapid price movement. It could be gaps as well as time. So let's define that. And I said voids are created by fast price movement. And we'll talk about how that looks, but right now we're just using a line chart for simplicity. It could also be made by gaps. Now, as prices gap up or down, well then there's that void between where it gapped from and where prices are at. In addition, price movement over time increases the void. So if we had prices moving up very rapidly, bar after bar, and let's just look at that a little bit. Give me a second here. So if we had that where prices were moving up, let's just go through our candle exercise of opens and closes, and it opened here and it closed here, and then it opened up where it closed and continued higher and closed higher, and then it opened up the area where it closed, moved up and closed higher, and it did the same thing again. It opened up and moved higher. So let's talk a little bit about what has gone on here and why it looks this way. So here I've drawn 4 candles moving up rapidly, where each opening price is at or near the area of the prior close. And it continued to move that way. And on the line chart, you just see one steady line, which is, I would say, more clear as to what's actually happening there. But let's talk about why this looks like this. So as you look at your chart and you see this picture, what's actually happening is just one continuous fluid movement, and these breaks between the candles are created by you saying, for example, program, show me a 5-minute chart, or program, show me a 2-minute chart, and now you've got more of these moving up. Okay? So you break up this rapid price movement. So under that rapid price movement, there is no support because of the speed at which prices moved. So one of the concepts to understand here is that there's a couple, actually. This is an indication or signal of extreme strength. However, it is the weakest part of the chart. And why is that if it is signaling such strength? Well, because you have traders, hedge funds, whatever it might be, high frequency trading algorithms, whatever it might be, where prices are pushing up here. And they are buying, they're taking the offers, and prices are accelerating to the upside. And that happens because there's a belief that prices are going to continue to move to the upside. So after the momentum slows down, and those that bought up here Some of them might be thinking, what did I do? I chased it on the way up. And so at that point, it's like, okay, let's see what happens. And if it goes sideways like this, okay, it's holding up at that point. Well, if it starts to pull back, this type of situation can feed on itself all the way back down. This isn't to suggest that it's going to happen, but there's that possibility. Prices could pull back. Let me see if I can clear this up here. Prices could push up. Could push up and then start to pull back and then to begin to create support. We talked about that a little bit. We're going to talk about it a little bit more. Okay. Now, let's just stick with the void concept here. So, now as prices go sideways over time and they build this support area or create it, well, as long as it goes back, continues to the upside, everything is great because all of these buyers from here that held on, they're getting their reward. On the other hand, if it breaks below here, well, now you have a lot of disappointed buyers. And this being the weakest part of the chart, the structure of the chart, well, and this going sideways through time, building what will become an area of resistance, it opens up the door to a large move to the downside. And here is the essence of the head and shoulders top, the ominous head and shoulders top, right? Because there's nothing more than a rapid price movement, distribution over time, creating a void below where prices could drop to the downside. So what we're doing here is we're simplifying these concepts. I'm explaining them to you so you understand them from what I would say a common sense point of view, not from a head and shoulders top or some type of indicator or some type of measurement of price and volume, green and red colors and dots and whatever else it might be to suggest that this is some proprietary indicator that will make you money. Okay? Understanding price movement and what's happening here and how it relates to the actions of other traders, investors, hedge fund managers, and such will tell you the likelihood of what's going to happen, and then we will manage that accordingly. I hope this is starting to make a lot of sense. So when does it have high odds of trending? When there's a void. This was a huge epiphany for me years ago as I studied so many of my trades and tried to figure out, why did this one work so well? And why was this other one such a disappointment? The void. There was no void. So it was one of two things. It was either there was no void or the markets had reached a point of being extended. And I don't mean extended like this. As I said, extended or overbought can become more so. But when we combine price patterns with market internal gauges, not indicators, gauges, right? We're really getting to some powerful stuff, and we're going to be getting there. So, rapid price movement, right? Sharp move down. Prices attempt to hold, and they do create some support here. Right? We'll talk about pivots in a little bit. It pivots and retests it. Well, the pivots at the top too. And now it begins to form reference points of support and resistance within a void. However, it breaks to the downside again. So you can also look at this as a way of, here's this very bearish pattern. Big wide range bar. Momentum slows down and it begins to go sideways here. And it's like, here you have the runner that's now catching its breath, right, within the race. Or the car that just went 100 miles and it just stopped to be refueled. And now it's fueling the tank. Is there a void below? Well, there's your trade. As you look at the patterns now that are forming, there's your breakdown trade. Now, the whole process starts over again, what we've been talking about, wide range bar. Is it in an area of support? And now it starts to chop sideways here. And as it breaks lower, it comes back up again. Well, it certainly could roll back to the downside. But here it gaps up. And now, in an area of resistance, it starts to go sideways. That's bullish price action. And note the bottoming tail bar right here. And now it starts moving up into the void. Very powerful concept. Rapid price movement to the downside, sideways through time, creating the void. And eventually, as we move through our other concepts, we'll start to look at patterns like this, and we'll determine whether in multiple time frames what was actually going on in those time frames. What was happening down here? Why did it stabilize and start moving sideways? Was the higher time frame in an uptrend? Was this at an area of minor support or major support? Was it in an area of minor support and a rising 20 MA moving average? So we'll begin to put more and more of these concepts together, and then as we trade them for the reasons that we will, as we put it together, we'll then manage them accordingly. So retracement in an uptrend to major support and bottoming tails. So the ideal scenario in an uptrend is to stop at minor support. And we see that prices actually did try to hold here. However, as it went up, there was a potent reversal back down. Longs get caught. And of course, there's going to be stops here. They exit. And then there's a void and prices move down to the next reference point, in this case being minor support. And then at this point, we haven't gotten into trend analysis yet, but at this point, the trend is still up because it hasn't violated major support. Now, we look at the candles that form, and we say bar by bar analysis, potent reversal. Well, that's one turn. This came down rather hard here. It is in major support. I know buyers are going to step up there, but the ideal scenario is to give it a bit more time. Now, I don't want to get too far ahead, but we could take a position here based on this 2-bar reversal with the proper money management strategies, but we'll get to that. On the retest, it creates a larger area of support. And then we have this reversal right back up again. Bottoming tails. Bottom with an S. And even if I tell you, what is this 2 bars if I squish them together? It's a bottoming tail bar. So we see that buyers are stepping up here. And then prices push higher and higher. Wide range bar, multiple bars up. Maybe it's going to stall. And doji bar, momentum stalls, pulling back again. It doesn't violate the trend, but it's starting to pull back. And as we get into retracement concepts, I'll tell you right now, this one here, greater than 100% retracement, anticipate a stall in the momentum, not a break in the trend, but you typically get a stall in momentum. I said this is a currency. We use the same technical strategies for currencies, for commodities, for stocks, for the broader markets. Everything's the same because it's based on you and I and others placing trades for whatever the reason might be. And that's what we're reading when we look at these charts. So here's a breakdown and a retest of minor resistance with a topping tail. So this isn't rapid price movement. You have choppy action here. And this is rapid. It moves up sharply, then it pulls back and it's chopping around some more, and it moves up again, and then it pulls back into this support. And it tells buyers are stepping up here rather aggressively. Look at the size of that wide range bar. They're not clearing this yet. So as it's chopping around, we really don't know yet, but based on what preceded it, we would think this could resolve itself to the upside because what preceded it was this nice move higher. And we do see that buyers were stepping up here, creating this support area, but it breaks down. What was support becomes resistance. Basic 101. Now it pops up into minor resistance and a topping tail. What was the topping tail before it became a topping tail? What did it look like? What were traders thinking? Look what it preceded it. Bottoming tail type of bars. So buyers had stepped up on the dip. I guess they were still hopefuls even after the break here. And it pushed up and we had a big green bar. But it turned into a topping tail bar. This tells us sellers took control. All those buyers over here said, wow, what a disappointment. Just let me get out of this dog. And when it pops up here, they just flood into it and drive it right back down again. It's a picture of beauty to sell something like this short. And if for some reason you got caught long in something like this, don't second guess it. Get rid of it. Short it. You can get rid of your long and short it. And it's going down into this void at this point. So, one other concept here, in that you say, well, Greg, since this wasn't rapid price movement, isn't there some support over here? Yes. And most of the time it's going to be all the way down here. Right? So a lot of students will ask me, well, how far to the left do I look? Well, the answer to that is until you see something. And then part of the answer is, well, how far away is it? So when we went through the bear market that started in March of 2000 and the NASDAQ went down 95%, and it went down for several years and then started going sideways, and as it started to move up, and eventually that failed and it went back down again. And then when it started to move up, whatever that was in 2009, and people would look over to the left and it was like, well, that was 9 years ago. It was, whatever it was, 5 years ago. How relevant is it? Well, as a technical trader, you look at that and you say, okay, I see it's there, but common sense tells me it's really not all that relevant. So when we look at the chart that we're looking at here, we see that and we say, well, the big picture here is that this bullish picture and this sideways action, that failed, and now there's all this resistance up here. I have to give the respect over here and the lack of respect to what's over here. So the big picture says it's going to go lower. Many students will think, well, hey, there's a little bit of support over there. I don't want to take that trade. No, when you have the setup here near this resistance area and with this kind of thing, you take it, your thinking is the big picture is going to get beyond the little piece of information over there. We'll cover that some more as we go on, okay? All right, we're done with part number 3. Let's go on to support and resistance, part 4. Let's talk about how support and resistance is created and break it down into its smallest component. We understand how this actually develops and how to read it. And we'll then talk about this in the trend section as well as we put that together. But pivots they start here with a bar adjacent to either side of it. It isn't really a pivot per se yet of any significance or strength. However, as time goes by, the more bars that are to the left and to the right create a pivot of significance. Now, we have to choose or make a decision as to how many bars we want to decide on what is a pivot of significance. And just having one on either side, while that does tell us that there has been a pickup in demand or some type of a turn here, I said that's really not significant. And at times, 2 bars on either side can be something of significance, but we're trying to find a happy medium, if you will. I've seen others that look at pivotal points in a somewhat similar way as this, and they might say, well, you need 6 bars or 12 bars or whatever it might be. But I found that having a minimum of 3 works out really well for calling it a pivot of significance. Now, how those bars form on either side, it really doesn't matter too much. The way have drawn them to have been created in like a fluid way is the ideal. However, it doesn't always happen that way, and I don't want to get caught up in perfection, so to speak. So let's just say, as long as these bars or candles that we'll be using have 3 higher lows to the left and to the right, we're going to say that this is a pivot of some significance, and we're going to recognize that an area of support or possibly resistance has been created. And here we have a retest, which creates a larger area, and here is a retest and a move up, which is creating a higher area, which is bullish. And so we have an initial formation of a reference point, and then a retest, which makes it more significant. And then as prices move up, the void concept that we spoke about, and prices begin to move sideways, it's now creating a higher level of support. And we recognize that as being very bullish, and it's can form a continuation pattern where we would be buying a breakout above here. Now, when we talked about candlesticks and we talked about tails, and we'll get into some failure pattern concepts, but just to point out here now so it's in your mind, just imagine a candle here. Let me just get my little drawing tool out here. A candle here, whereas maybe there was a tail on the bottom where it poked down under these lows and then held. And that little shock to the downside there, as we talk about support and resistance and supply and demand, the effect of that is to remove some potential supply. Let's talk about that for a second, about what that means. So as prices go sideways here, and prices, buyers now are looking at this, and let's just say they bought here, right? And they see prices go up, and they're hoping that it continues to go up to profit from a move higher. Well, this move under here would probably, so we could probably be pretty sure of that, the very nervous traders, if you will exit their long position to protect whatever profit they had here. And by that happening, it helps remove some of the potential supply of them selling as it starts to go up. So a little bit more of an advanced understanding of that supply and demand, and why we really look at these kind of shock or tail bars or little breakdowns like that as being very powerful, and what we would really like to see in the type of patterns where we're buying a breakout. So here we have a situation where prices had been moving down and then fell very sharply and stabilized and then retraced again. So the trend is down. Prices are still below this major resistance area here. So as prices are in a downtrend, we look to profit by selling short. Now, as prices came up here and we get the initial reversal to the downside, this is one place that we could be selling short. But remember, this is in a void here. And so after a climactic drop, let's just back up for a second here. So because here we have a little sell set up here, but notice that it's right in the area of price resistance. And that's okay, this type of a sell setup. Now, I'm really focused on here is sell setups after a climactic drop, not taking the first turn. Right? So here's the start of a first turn there, and this is pretty common about what happens, and then it goes further up. The really high probability setup here is the M top, or this creation of resistance where it forms a pivot and then retests it and starts to roll back over again. You can short it on the breakdown. Of course, your stop would then be up here, or you can short it here on the retest into minor resistance. Now, I'm saying here proper money management could make that first reversal okay. And we're going to look at this in depth when we get to that section. But what you would be looking to do in a situation like that would be, if you were entering here, you'd be putting your stop well up here, up above here, where this, because if it could pop back up here, and this is your major resistance, and then we would look to add to the position at the appropriate time. So just touching on that. But here, this type of setup, the move up creates the pivot, creates the retest, and then the break into the void. That is a high odds type of setup after a climactic drop. Okay. So absorbing supply by moving sideways at resistance. A lot of students from the past kind of get a little confused or caught up in the terminology. And I like to explain patterns in a way that kind of communicates the actions of what's going on there. And so when I say it's absorbing supply, what I want you to take away from that is that here, as prices came up into this resistance, remember I associated resistance with supply. This is where sellers are. And for some reason, somebody was buying here, and it went down, and somebody else bought here, and it went down again. So those longs are holding losses. So when prices come back up to resistance, where those longs are holding those losses, that is supply. So we associate resistance with supply. Those longs want to get their money back. They're happy to get their money back. Who doesn't like to break even? Now, as it comes up here and they sell into it, and notice the move up being sharp creates a void underneath. And as this now forms a pivot, and now it's retesting and it creates a larger area of support, as it's going sideways here in this area of resistance, absorbing that supply, that is bullish price action. So rather than pulling back, pulling down in price, getting pushed down, which it could pop back up, but it's not being pushed down of any significance. It's not pulling back to a minor support level. It's creating new support. So when you see sideways price action in an area of resistance after a sharp move up, power tells you that buyers continue to come in here. That's bullish. And look what's above here. There's a void. Little resistance area over here that's going to have to be dealt with. Remember what I said. This is minor in relation to this big picture over here. So I've often been asked, Greg, why would you buy here or recommend buying here when there's this resistance over here or this resistance right here? Well, because this is absorbing that supply. It's bullish price action. Why not wait until it gets above here? Well, then the question is, well, why not wait till it gets above here? How long are you going to wait? When you have a bottom forming and the price action that was going on here, look, no follow-through, volume, potent reversal, all of the things that you should be starting to recognize here, the pivots, the retests, and so on. Based on the big picture, my assumption is it's going to take this out. Right? It's the same thing when you have an uptrend. Let's look at that for a second. You have an uptrend, right? Higher highs and higher lows. And you buy the pullback to minor support. Well, you could ask yourself the same question. How do I know it's going to get above here? Because the big picture, the uptrend, and whatever pattern is going to form here suggests that it'll do that. Do you know for sure it will? No, but that is trading. That is investing on technicals. You look at the big picture, you look at where the odds are, and you take a calculated risk in the odds of the big picture that it's going to continue. Absorbing supply by moving sideways. Just another example of the same thing that we just covered. Right? So here is a sloppier bottoming type of a pattern, but this is how they form at times. Momentum picks up a wide range bar and it goes sideways in the area of resistance. Buyers are absorbing that supply without prices pulling back to support. Look at the red bar ignored. Clearly a big red candle, potent, engulfing, suggesting it would pull back. And it just served to be a pullback. And if we were to look at smaller time frames, you would see the transition from red to green. We're going to talk about that when we get to multiple time frames. But buyers stepped up here. This is a little area of support in a smaller time frame, and it just pushed back up. And here in this time frame, look at that beautiful little bottoming tail bar, ignoring the topping tail bar, and off it goes back up again into the next resistance area where it reacts. Clearly, can it get through here? I don't know. This pattern suggests it will. So maybe at this point we start trail stopping, money management. Maybe we sell part of the position. We'll get into that in position and money management. Creating new support to repair the damage. At times, even in a bullish trend, something goes wrong to upset the equilibrium, so to speak. Could be a bad day in the market. Some news came out. And here we had a bullish move up. You see the momentum pushing higher. This consolidation creating support, and then a continuation move, pointing out the wide range bar here, suggesting the end of this move. And then it stalls, a little topping tail bar, pointing out the volume. And then it begins to pull back into minor support. And buyers begin to step up, and the momentum slows. And it starts to turn back up again. And something happened. And as I said, it could have been a bad day. And at that point, the pattern that it's formed here and the trend and the bullishness of the uptrend and the higher low and the moving up and so on, that's over. It's finished. But that doesn't mean it can't come back from that. So, as this tests what's now minor resistance and this topping tail forms, we really could be thinking sell short here. And we might. And it wouldn't have worked. Right? But here, as the damage gets repaired and it turns back up, let's just assume for a minute we got stopped out here. And it was like, hey, it's going to happen. It's going to happen. And as this comes back up, this is a whole new scenario here. So you shake off, you've taken your calculated risk, you're over with it, and you see what's happening here, and you're saying, you know what, this is really bullish. Whatever happened over here, it's done. Forget about it. Sideways at the top of a wide range bar, creating a support point. It's got room up to the upside here. Get long this. You have a new reference point of support that was created where you can place a stop loss, creating resistance after a void. Look at this sideways move here. Look at the shock. Great topping tail shock. It tried to break out. What was it prior to becoming a red topping tail? Green bar. Right? It was a little breakout that failed. They're caught. Longs are caught. What do longs do when they're caught? They run, they sell, they hit the bid, and down it goes with a wide range bar igniting. And here is a nice little sell setup. Right? It just started the move down, and a little sell setup here. I'm not crazy about it, to tell you the truth, but it is what it is. That's their first sell setup, and you don't have much resistance here, but we can manage this with the right money management. But over here where it's creating this resistance gives you a new entry point here. And then at that point here, it's creating resistance again as it goes sideways. And, we then start to say, well, look at this little move to the upside here and that topping tail, which formed a pivot. As long as it doesn't get above that, this is okay. And now your job is to look to the left. Is there a void under here? And if there is, this should be heading south. Rounding top versus a V-top. Master trader key concept. Pullbacks from a rounding top will often result in a failed pivot type of buy setup. Better to get a W pattern or a retest has better odds of advancing. So a few things going on here. Let's just back up a little bit here. As this fell sharply, and then you got a wide range bar pushing to the upside, and it came up into this resistance here. Let's clean this up for a second and get the laser pointer. V-top, which tells us that longs exited quickly to get out at that resistance. And why shouldn't they? This was in a downtrend and fell sharply. So anyone that got long here on that reversal, they're just taking their money. But here, buyers stepped up here again, V-bottom, aggressively in this little shelf of support here. Look at the reaction to the high. Bullish price action at resistance, going sideways there. And then as it comes up into this resistance area and begins to form this top, it looked like it was going to push higher, never by this type of a continuation pattern in the face of resistance. And as it poked up here, it then created this resistance area and this high pivot, and then started to break to the downside. So pullbacks into this support, you don't want to buy those in the face of this rounding top. And waiting for a retest pattern, there are two concepts going on here. Let me just draw it over here, and that would be, here's your rounding top, which is bearish, and as it pulls back by going sideways, time moves prices away from this reference point, or what created uncertainty here, little breakout that failed and the move back down. So as you move away from bearish patterns, they become less potent or significant over time. And just go a little further with it, and as it went sideways over time, let's just extend it and get further away from that. And where we would say, well, do we want to buy this breakout that's moving higher? Well, what about this resistance? Well, I would say, if we're looking at a daily chart, and I would say, well, 3 months went by. I don't really care about this anymore. It might stall there, but I want to trade this in the void. And when it gets there, we'll see what it does. Okay. Gap creates a void, right? And the retest creates resistance. So here was a gap down. It was a gap down under this support, and now there's this big void here. Sometimes prices will get up into this area, and that would be an ideal place to put on a short position up there. But what this tells us is that this was creating a resistance here, and we don't have bars to the left over here, but let's just use some common sense here and be a little flexible and say, well, here's this big gap down, and we got the bars here to the right, and we're just going to call this, I won't call it a pivot, I'll call it a reference point that others are going to focus on as a probable selling point. And here where it rolls back over again, this is where you want to sell it short. 3 bars are the same as a topping tail. So when you see this pattern, it may, say it looks a little foreign to you maybe, or you don't recognize it as a sell setup. But when I tell you this 3 bars and you think about the retracement concept here as a topping tail, if you visualize that, you'd probably say, I got it, Greg, I see it. yes, I do see it, and I will sell that short based on that pattern that has created resistance after a very bearish gap down. And then as it moves down, we don't know why it popped back up here, but it could be market related. Maybe there was some support here. We're always looking to the left to see where there might be a reaction, transfer of support that becomes resistance. Now, another little bit of an advanced concept here, but what you really want to think about here is the fact that this bullish pattern broke down. Right? So here's two pivots. And we'll talk about this in the trend section, but the break of two pivots is bearish, breaking down below this significant support area now. And as it came down, it went to the next support area, and it stopped. And you can see it stopped right here, big green bar. And so here is a support area where possibly you could build up new support to try and move back up into this void here. And because as prices moved down, it created this void. And buyers could step up here. It formed a pivot, and there was a retest, and prices could have started to move up over here, but they didn't. So at this area of support where those that want to get long recognize this and they start to accumulate here, you're actually having a supply coming in and building up a new resistance area. Now you might be saying, well, when do I know it's resistance, Greg? You know it's resistance after it breaks down, after the fact, right? We wouldn't know that it's actual. We know that it's support once it forms a pivot and then once it retests. But we would not go long something like this after such a breakdown. So once it breaks, it's clear that there's resistance here. And here's a nice little sell setup right over here. Right? Notice the topping tail, little shock. Think about what it was prior to a topping tail. Think about what preceded it. The retest. The move up, it was a green candle. As buyers stepped up here, they got caught. And now they're saying this isn't working. This reversal set up here in this area of support, and after this gap reversal and coming down to retest it, and as long as they're caught, it's breaking. Let me get my money back. Let me be done with this thing. It's not working. And if there's a void below, which we're always going to look for, hey, sell it short. All right, a review. Minor support is the high prior to a higher high. Major support is the low prior to the higher high. The strongest of trends, they'll reverse at minor support. New support within a void starts with the pivot. And let me just say, the strongest of strongest trends will not pull back to minor support. They will create support. And let's just, we talked about that a little bit, but I like to reinforce these things. And so, uptrend, and rather than pull back to minor support, it pivots. It retests, it goes sideways, and back up again. It creates new support. It doesn't pull back to minor support. And so you might be thinking, normal thought, this is a little extended. I don't want to buy here. I don't blame you. Neither do I. But after it creates a new support point, it tells me that demand is strong enough to create this support, and then I am willing to buy it. And of course, you're going to look at the individual candles that form in this area. Is there a little bottoming tail bar or a long, big bottoming tail bar that takes out some of that potential supply, shakes out those weak hands? So as we look at bar by bar and we put that in the context of a trend, which we're going to be getting to trends, in a strong trend and creating support, is there a void above? All of these things coming together guide us to high probability trading setups or swing trades or core trades. Right? It's all related to the time frame that we're looking at. Ideal uptrends form V tops and V bottoms, right, at minor support, or they create new support. Rounding or square tops within an uptrend display distribution. Check multiple time frames. MTF, check multiple time frames. Prices moving sideways at resistance is bullish. And prices going sideways at support after a downtrend, if it cannot go up, it's bearish, and you look for lower prices. That's the end of support and resistance. You probably want to review it again. There's a lot of great information there. And I'll tell you, as we get through the information here and you're taking the course, I don't know that you want to wait till the end of the course. There's a lot of information, but you're always welcome to email with questions about a particular concept if you need some clarification. Right? Hope you're enjoying this, and you're always welcome to email with some accolades and, if you're having some light bulb moments really like that.